Imagine an auction happening every single day in every city on Earth. Almost nobody realizes they're a bidder in it. There's no auctioneer's hammer, no gavel, no room full of paddles in the air. The auction is for a fixed set of things: land, homes, hospital beds, college seats, even your own time. And there are only ever two kinds of bidders in the room. On one side, there's you, bidding with your paycheck. On the other side, there's capital. Pension funds, private equity firms, corporations, index funds. They bid with money that never gets tired, never needs sleep, and never has to ask permission to keep going. Guess who wins more often? This isn't a story about greedy villains twirling mustaches in a boardroom. It's a story about an auction most people don't know they're losing. Nobody ever told them it was an auction in the first place. Let's call it what it is, the invisible auction. Once you see it, you can't unsee it. Here's the strange part. The auction isn't rigged by one group cheating. It's rigged by an asymmetry, a permanent structural mismatch in who's allowed to keep bidding after everyone else has run out of money. A worker bids with a paycheck that resets every 2 weeks. Capital bids with money that compounds every single day, forever. It doesn't need to eat, pay rent, or take a sick day. When those two forces compete for the same scarce thing, a house, a hospital stay, a retirement, one of them is playing a short game. The other is playing an infinite one. That mismatch is the real engine behind why so many people feel like they're working harder than ever and somehow falling further behind. Let's start with housing, because it's the clearest version of the auction in action. Contrary to what you might expect from headlines, giant Wall Street firms don't own some enormous slice of America's homes. Institutional investors with over 100 properties control roughly 3% of single-family rentals nationwide, according to Brookings and the Urban Institute. That number sounds almost reassuring, until you realize it's concentrated in specific metro areas. In those places, large investors can control more than 12% of the rental stock. That's enough to move local prices in neighborhoods where ordinary buyers are already stretched thin. Meanwhile, in the apartment market specifically, private equity firms have quietly built up ownership of roughly 3 million units. That's about 13% of all apartments in the country. Look at how the strategy works, and it starts to look less like investing and more like a formula. Buy a building, raise rents, add fees, sell it a few years later for a profit. Repeat. In one documented case, a major firm raised average rents at a property from about $1,100 to over $1,500. That happened in just 4 years. It's a jump larger than the broader market saw over the same stretch. Multiply that pattern across thousands of properties, and you start to understand why the market can feel like it's working against you personally, even when no single villain is choosing to target you. Now here's the twist most people miss. The villain in the housing story usually isn't the hedge fund. It's zoning laws that block new construction. It's permitting delays that add years to building anything. It's local governments that treat scarcity as a feature rather than a bug. Existing homeowners like watching their property values climb. Wall Street didn't create the housing shortage. It just got very good at exploiting one that towns and cities built themselves. One restrictive zoning meeting at a time. That's the pattern you'll see across this entire auction. Capital rarely creates the scarcity. It just shows up with more patience and more money than you have and waits. Let's move to a second arena of this auction. This one might sting a little more because it's supposed to be the ladder out, not another obstacle. Education. In the 1960s, a student could work a summer job and cover a meaningful chunk of a year's tuition at a public university. Today, tuition at public four-year schools has climbed for decades. It's dramatically outstripped inflation and wage growth. Meanwhile, state funding per student has been cut in many places since the 2008 financial crisis. It was never fully restored, so schools raised prices to cover the gap, and families covered the difference the only way they could, by borrowing against a future income they hadn't earned yet. Here's the twist. This wasn't a market failure exactly. It was a market functioning perfectly for the people selling the credit. Every dollar of student debt is an asset on someone else's balance sheet. A loan is a liability if you're the borrower. But it's an income stream if you're the lender. Steady, federally guaranteed in many cases, nearly impossible to escape even through bankruptcy. The system didn't fail to build a bridge from education to opportunity. It built a very profitable toll bridge and called the toll investing in yourself. Now let's talk about a third bidder in this auction. One that's newer and, frankly, a lot faster than the others. Automation and artificial intelligence. Picture a mid-sized regional bank in the early 2000s. It employs hundreds of loan officers, tellers, and customer service reps in call centers scattered across small towns. These were solid, unionized, adjacent jobs that anchor entire local economies. Over the following 2 decades, algorithmic underwriting, mobile banking, and AI-driven customer service quietly replaced layer after layer of that workforce. The bank doesn't get less profitable. It gets dramatically more profitable because the cost of serving each customer collapses while the price it charges barely moves. Where did those savings go? Not into raises for the remaining employees, and rarely into lower fees for customers. They went into the same three places money almost always goes when labor loses bargaining power: shareholder returns, executive compensation, and reinvestment into more automation. This is the quiet danger of the AI moment we're living through right now. The optimistic case says AI will make everyone more productive, and that's probably true. But productivity was never the missing ingredient in the story of stagnant wages. The post-war era already proved that productivity translates into shared prosperity only when workers have the leverage to demand their share of it. Without that leverage, AI doesn't share gains. It just gets better at deciding who's replaceable, and it does that job faster than any technology before it. Let's zoom out and talk about the fourth bidder, the one hiding in plain sight in your retirement account: the stock buyback. Here's a fact that surprises most people. In the 12 months ending in the third quarter of 2025, S&P 500 companies spent just over $1 trillion buying back their own shares. That's the second time in history that figure has crossed the trillion-dollar line. Analysts expected authorizations to climb even higher into 2026. A buyback is simple in concept. The company uses its cash to purchase its own stock. This shrinks the number of shares available. It mechanically boosts earnings per share and often lifts the stock price. It's not illegal, and it's not even irrational from a shareholder's perspective. But ask yourself a basic question: what else could that $1 trillion have done? It could have funded wage increases, it could have rebuilt pension plans, it could have expanded apprenticeship programs, or lowered prices for customers. Instead, in the third quarter of 2025 alone, the 20 largest repurchasers accounted for nearly half of all buyback spending in the entire index. This wasn't broad-based reinvestment in the economy. It was a concentrated transfer to the people who already owned the most stock. And who owns the most stock? Not the median American family. The wealthiest households, whose portfolios grow every time a company decides that buying its own shares is a better use of cash than paying the people who make the product. Now, here's where I want to challenge a popular narrative, because I think it lets the real story off the hook. It's tempting to imagine a single moment when things broke, a policy signed in a back room, a scandal, a villain. But the truth is, less cinematic and honestly more unsettling. Nothing broke. The system is working exactly as its incentives were redesigned to work. That redesign started in the late 1970s and 1980s. That's when the idea took hold that a corporation's only real obligation was to maximize returns for shareholders. Before that shift, corporate leaders talked about balancing the interests of employees, communities, and shareholders together. However imperfectly they lived up to it. After that shift, the language itself changed. Workers became labor costs to be minimized, not people to be invested in. Once that idea won, every bidder in the invisible auction got a new set of instructions, and those instructions all pointed the same direction: extract more, distribute less, and call it efficiency. Now let's bring in one more piece of the picture. I think it's the most human part of this whole story: the psychological cost of losing an auction you didn't know you were in. Think about someone doing everything right, working full-time, avoiding frivolous spending, maybe even picking up a side gig through a delivery app on weekends. That side gig, by the way, isn't really a symbol of hustle culture. It's a pressure valve. It exists because the primary job's wages stopped covering the primary job's cost of living. So an entire secondary labor market emerged just to fill that gap. One that offers no benefits, no security, and no seat at the bargaining table. When that person still can't get ahead, the temptation is to internalize it, to assume the failure is personal, a budgeting mistake, a lack of discipline. But you can't out-budget an auction where the other bidder has infinitely more money and infinitely more patience than you do. That's not a character flaw, that's arithmetic. So where does this leave us? Is the invisible auction simply unwinnable for ordinary people? Not entirely, and this is where I'll push back on pure fatalism. History actually offers a specific playbook, even if it's an uncomfortable one. Every era in which ordinary workers gained real ground did so through organized leverage, not individual willpower. Unions negotiating collectively rather than employees negotiating alone. Public investment that expanded access to education and housing rather than leaving it purely to private lenders. Regulatory guardrails matter too. Take the recent federal action limiting the largest institutional investors from continuing to scoop up single-family homes, signed into law in the summer of 2026. However limited its immediate impact, it signals that the rules of the auction aren't fixed in stone. That particular law probably won't transform affordability overnight. The largest institutional buyers still hold well under 1% of the nation's homes. But it matters for a different reason. It's proof that public pressure can still change which bidders are even allowed at the table. That's the lever that's always been available, even when it doesn't feel like it. Not outworking capital, because you can't, but organizing enough collective leverage to change capital's terms. Here's my honest take, and you're welcome to disagree with me in the comments. I don't think the invisible auction is a conspiracy. And I don't think the people running it wake up each morning twirling a mustache. I think it's something quieter and in some ways scarier. A system so well optimized for its stated goal, maximizing returns to capital, that it doesn't need villains to keep producing an unequal outcome. It just needs everyone else to stay confused about the rules. That confusion is the real product being sold. It's sold every time we're told the economy is strong purely because a stock index went up. Or that a booming GDP means everyone is thriving. GDP doesn't pay your rent. The stock market doesn't cover your insurance deductible. Somebody's portfolio growing 8% this year tells you almost nothing about whether the median family down the street can afford next month. So the next time you hear that the economy is doing great, ask a sharper question. Doing great for which bidder? Because there are two of them in every transaction that shapes your life. You bidding with a paycheck that resets, and capital, bidding with money that never sleeps. Understanding that isn't going to fix the auction by itself, but it changes what you do next. It turns personal shame into structural clarity. And structural clarity is the first ingredient in any organized response, whether that's collective bargaining, political pressure, or simply making smarter decisions with the leverage you do have. The money in this economy didn't vanish, and it isn't hiding in some secret vault. It's sitting in plain sight, in rents that outpaced wages, in tuition that outpaced state funding, in buybacks that outpaced raises, in a housing law passed because enough people finally asked the right question out loud. The auction is still running right now, today, while you watch this video. The only real choice any of us has is whether we keep bidding alone or start bidding together. If this changed how you see the economy around you, subscribe, because we're going to keep pulling these threads. History doesn't repeat, but the auction never really closes. I'll see you at the next lot.